So, hello and good afternoon. I welcome you to today's special webinar, NFPs ahead, which scenarios to expect. My name is Jens Klatt, and I'm exclusively presenting this format to you here for JFD Brokers as their global head of research and education. And yeah, so the thing is that I was a little scared. Yeah, scared is probably a wrong word for this, but I was skeptical, let's say. If there's such a huge chance to get to see big volatility around the NFPs tomorrow, and if there's really so much to discuss around this topic here, yeah, well, what shall I say? I mean, yesterday's Fed decision was a very interesting one, let's say. So all in all, no one really expected the Fed to come out in a let's call it in a way they came out with their decision. This in fact also now will potentially affect the outcome for the markets in general. Not necessarily sure, by the way, for Euro USD. And there's some very interesting things happening right now. Euro USD is a little different. By the way, this is something we want to have a look at a little later on. By the way, oh, I'm sorry. Let me just skip this because the header is not correct. But let me just, first of all here, switch over to Bloomberg. And at Bloomberg, we can click here on menu. And there you have the chance to look for markets. And there is the economic calendar. By the way, they switched their layout, so it looks a little different. Usually there was orange. Yeah, that orange here, but somehow they just for whatever reason came down to black and white. And here in the economic calendar, the great thing about this is that you can have an overview of what the market expects in terms of the employment situation tomorrow. That's something we want to have a look at a little later on, where the data has to come out and in which direction this will potentially push the market. But more interesting probably is what happened yesterday here at the FOMC. And therefore, I already prepared something which I presented in the morning meeting, which is usually taking place at 9:30 a.m. GMT every day. And that was something I presented there already. It's an article from Zero Hedge from yesterday in the evening. Very interesting summary of the developments here. So headline reads as follows: FOMC leaves rates unchanged, leans hawkish on inflation, dovish on growth. And this is something which is in fact, yeah, to be honest, it's not coming with a surprise, since we all knew already, I think, that there is some skepticism, or should be some skepticism around the economic outlook for the US economy in general. But, and this is the thing, it was really interesting to see that it was clearly communicated within the Fed statement, which was published yesterday. And this is something which is now potentially having some effect on the situation we get to see around the NFPs and the potential reaction around the NFPs tomorrow. So first of all, let's have a look here at those key highlights. So rates unchanged, okay. Decision anonymous, okay. Inflation has moved close to 2% target, okay. And this is very interesting. Fed sees inflation running near symmetric goal medium term. So this word symmetric is in fact the thing which was very interesting to look at yesterday, because Zero Hedge puts it down like that. It says, it says the addition of the symmetric language traditionally has indicated that the Fed is willing to overshoot on the upside with inflation, hence the hawkish tilt on inflation. The Fed also removed the line about monitoring inflation developments closely as it reaches its 2% inflation target. So, and now the other hand, the Fed completely removed the following sentence: the economic outlook has strengthened in recent months. So this is what they removed, meaning that they become skeptical about the economic outlook for the future. On the other hand, seeing nevertheless chances high that inflation will pick up, and they are probably willing to let it overshoot. Yes, nevertheless, they will hike rates, but but again, they are seeing inflation rising, why the economic outlook is not that bright anymore. And we know this. We know this word for such a development. We call this stagflation. So we see the economy stagnating, not necessarily shrinking, but stagnating, while inflation picks up. And this is something you, in fact, want to avoid under all circumstances, because now the thing is that we are potentially, I'm not saying that this will happen, but nevertheless, chances are at least there that we potentially will see the Fed hiking rates into an environment which is not seeing the economic growth which you usually want to see. So which could then result in the economy shrinking even more and losing even more momentum, let's say. That's probably the better way to put it. And this is kind of a vicious circle, if you want. So why is this very interesting? Well, we already saw the reaction in markets yesterday. So first of all, let's have a look at the DAX, because this is one of the main assets I'm trading with. The DAX already showed some significant strength in the morning, pushing significantly higher, mainly driven by the push above this significant resistance here, which is now, by the way, acting as potential support on the downside. And we headed towards 12,800 points. What's even more interesting is, if you look at the reaction after the Fed, you usually know that this, all in all, is not very positive for equities in general, because if the economic outlook shrinks, this is usually something to become skeptical about the outlook for companies in general, which is usually bearish for companies. That's in a very rough way. I'm presented in a very, very rough way here. But the DAX, in fact, yes, it reacted somehow bearish. Yes, it came under pressure. So we felt something like 40 points here. But this is indicating that potentially the main driver, especially when looking at trading hours, which are usually, or the highest volume traded in the markets, is usually between 7 a.m. GMT till 3:30 p.m. GMT. So this is when the Xetra trading takes place, and this is usually the window in which you see the highest volume traded. So now the interesting thing is that the DAX obviously reacted in a bearish way, but it didn't come under so much pressure, to put it that way. If you carefully watch what happened in the S&P, you can clearly see, okay, obviously the US economy here, and the outlook, which is not that positive. If you read between the lines what the Fed just presented to us, the S&P sold off quite sharply. So we lost more than 1% from the daily high. So initially there was a bullish reaction, and then we started to sell off here into the last minutes of trading. And the interesting thing is that one of the main reasons why the DAX was capable of stabilizing at this elevated level after this bullish push here in the morning is potentially because of the euro. Because the euro presented itself in a very, very bearish way, not just yesterday. I'm sorry, not the euro, the US dollar initially reacted in a bearish way. What do I mean by that? Probably it's better to have a look here at the US dollar index future. So look at this. So initially we sold off. Why? Well, because if the economic outlook is not that positive anymore, it's not only yields which are driving capital, or no, let's put it that way. It's not only yields which drive capital flows, inflows, respectively outflows, into, respectively, out of an economy, but it's also the outlook for the economy in general. So it's not just that you're looking for yield, but you want to invest in something which has a positive growth outlook. Usually you see, if the economy strengthens, it's not only that the central bank potentially hikes rates based on the assumption that if they hike, or if the economy starts to gain momentum, then usually inflation will pick up. And to not let inflation overshoot too aggressively, you usually tend to hike rates then. But on top of that, there's also this positive outlook for the economy. The thing is, if you look at the statement from yesterday, well, there is not this positive outlook for inflation. The Fed, yes, they have to hike rates. Nevertheless, it's not induced by the economic outlook based on which you expect inflation to pick up, but it's mainly probably the reason can be found in the monetary policy of the last, let's say of the last century somehow, since 2008, since the big economic crisis here. And that was potentially the main reason why the US dollar sold off sharply at the very first beginning, at the very first moment. But now something interesting happened. The US dollar gained pace here again, and everyone was some kind of irritated, let's say. So to me, that move didn't make sense. But what it definitely does is to give you an idea of when the market will definitely bring up a corrective move in the US dollar, which will usually be the case if we drop below 92 again. So this is my line in the sand, if you want to put it that way. So the moment we are pushing below 92 here in the US dollar index future, in this moment, I think chances are high that the US dollar will see some serious pressure on a broad scale. You can completely invert this picture here and have a look then at the Euro USD. It's a similar picture, because here you could say, okay, if you look at the price action from yesterday, so by the way, one of the main reasons why this is nearly completely inverted has to do with the fact that 60% of the US dollar index future is in this basket against which the US dollar is calculated here is euro-based. So that's the main reason why the picture nearly looks 100% the same, with the only difference of the 4 sign here. So the thing is that if we're now pushing, let's say, above 120.20 to 120.30 in the Euro USD, that's a bullish sign to me. Now, and this is the interesting thing, when could this be? When could this happen? Such a push here, because this will be our, let's call it, line in the sand for the Euro USD when looking at the non-farm payrolls tomorrow. That will potentially happen if NFPs disappoint. Why? Well, because the outlook for the US economy highly depends on how the employment situation looks like. So meaning, if NFPs disappoint, come in below expectation, we'll have a look at clear numbers here a little later on based on the consensus rate from Bloomberg. But let's make it very easy right here, first of all, and say, okay, numbers come in below expectation. That usually should bring up bring positive momentum into Euro USD, where the line in the sand around 120.20, 120.30, once it is broken, will potentially result in further upside momentum. Now, the interesting thing is, and that's one of the reasons why I don't want to look at Euro USD here, because I think, especially pound sterling against US dollar, potentially is more attractive once data disappoints tomorrow, if it disappoints at all, that's the thing. But if it disappoints, I think pound sterling has way more potential for a strong corrective move here on the upside than Euro USD has. And this is mainly due to the fact that today inflation data for Eurozone was published, and it came in significantly below expectation. And this said, it means that I think it's a perfect tweet. I retweeted it in the morning. 1 second, please. I just show it to you. So here's again So it's from a Reuters journalist. His name is Jamie McGeever. And there you can see it. Eurozone flash inflation slows unexpectedly to 1.2%. Respectively, core inflation is down to just 7.7%. And this is the key. It's hard for the ECB to justify taking its foot off the easing pedal anytime soon with figures like these. I completely agree with that. By the way, and it's a chart of failure, let's call it. It's very interesting. From a German analyst in this case. It's showing here the ECB balance sheet, which is pushed to even higher highs, and core inflation is not picking up. Inflation in the Eurozone is not picking up. Something, by the way, which would be highly welcome, let's say, from the Fed, because based on that, they could easily argue why hiking rates is not such a good idea. Something which is currently, if you look at the statement from yesterday, obviously not an option. But let's come back to the euro. So This data set here and this development is something to really worry about, and something which is clearly underlining, in my opinion, that we should be really careful, or not just careful, that's the wrong word for this, but probably even if the US dollar will see a corrective move, I'm not really sure if the euro is the perfect choice here if you want to short the US dollar against another currency currently, and in this case betting on at least a short-term corrective move. And that's exactly what we're talking about when looking at the NFP. So it's only one data set, and the overall monetary policy outlook, the path the central bank of whichever country, in this case the Fed, will follow is not affected by only one data set, in this case the non-farm payrolls tomorrow. Nevertheless, for short-term traders, and based on the price action of the last days here, that's definitely something to yeah, it's worth considering. Let's put it that way. And so if you're then betting that the US dollar probably will come down, mainly due to the fact that data potentially disappoints, well, again, euro is probably not the best choice in this case, but probably the best choice will be GBP here, which is which sold off quite sharply from the highs here, yearly highs around 2 weeks ago, when we pushed towards 144 respectively. We're traded around 143.70 here, and then several data sets disappointed. There was a comment that is 2 weeks ago from Mark Carney, coming up with something where he said, well, there are other meetings here in 2018, so we don't necessarily need to hike at this next meeting, in this case at the May meeting here, and where we saw a probability of over 80% that the Bank of England is expected to hike rates at their next meeting in May. We are now down to below 20%. We're looking at the swap markets, and pound sterling sold off sharply. Not only that it lost some pips here and was pulling back from the yearly highs, no, but it gave back all the gains it has seen so far in 2014. So we started the year somewhere here around 136, and this is exactly where we're currently trading, which means we nearly gave back all gains which we've seen so far. In this currency pair, in pound sterling against the US dollar. The thing is that, to me, pound sterling looks a little oversold, and there is still some chance that probably the Bank of England will nevertheless, even if they do not hike rates at their next meeting, will potentially come out with something like giving us minimum a chance that there will be a hike. Definitely there will be one hike in 2018, and depending on how fast such a rate hike could come, well, this is something which could then result in a quite aggressive move here on the upside in pound sterling, and which could be anticipated then already from the NFPs tomorrow, where potentially the numbers come in below expectation, and then pound sterling can gain some significant traction. Even though, something else I want to add here, I really don't want to be long pound sterling against the US dollar below these highs here. So this is the high 50-minute chart. It's the high from yesterday around the Fed. So I'd really like to see pound sterling going back above 36.70 here, if I want to be long, because here we are still in a very, very bearish environment, even though it looks extended on the downside. But the negation of this sequence of falling highs and falling lows is in play once we make it back above 36.70 here. Yeah. And so that's one currency where I could imagine, well, which I could imagine to be interesting. To be honest, I mean, it's a very, very aggressive approach, because pound sterling has seen some serious pressure from the upside here over the last days. But again, it looks extended, and that's potentially one good reason to see pound sterling reacting in a more aggressive way than when correcting some of these losses here than we'll see in the euro, based on those data which came out in the morning around the inflation. Same is true, by the way, for dollar Japanese yen. When looking at the dollar Japanese yen, you can clearly spot that the market has definitely some trouble to gain further momentum. Remember, it's a little away, or it's a little away from a time perspective. So I was and I'm still very skeptical about dollar Japanese yen. Some might be probably a little surprised because during the morning meetings and when looking at the okay, one second. There's a question referring to crude oil. We'll have a look at crude oil a little later on. Okay. So I read the question. I will have a look at crude oil. Nevertheless, first of all, I think it's more important to have a look here at the FX markets and the potential developments which we'll probably see then around the US dollar. So during the morning meetings, I was usually very skeptical around dollar Japanese yen, and that was especially true here during March around when I said, well, even if we make it back above 108, I'm still very skeptical if I want to be long dollar Japanese yen, since I consider the currency pair to be bearish below 110, 110.50. If we make it back above this level, okay, but nevertheless, I'm very skeptical. So now this bottom forming, let's say, it kept on and we potentially formed a bottom here and then finally break out above 107.50 to 108 and saw some serious momentum taking on dollar Japanese yen taking on some serious momentum here on the upside. Nevertheless, the interesting thing about this is that we are currently still trading below 110. So there was yesterday a small spike above 110, but we were sharply sold off, or we sharply sold off from there again. And we can see that currently here, dollar Japanese yen is obviously seeing some serious trouble, gain further momentum, but instead is pushing back towards 109. And so this is the next thing. What we know is there's two things we know. First thing is that dollar Japanese yen is usually highly positively correlated towards the yields curve, respectively, in general, 10-year yields. So 10-year treasury yields in the US. Meaning if yields rise, usually expect dollar Japanese yen to rise too. And if they fall, usually expect dollar Japanese yen to fall too. Second thing is somehow between the lines it's connected to risk on, risk off mode, but let's skip this here at this part and only look at the risk aversion, respectively risk on, risk off mode. What we also know is that Japanese yen is usually used as a carry trade vehicle, meaning if you have a risk on mode, you see market participants borrowing Japanese yen and buying higher yield currencies / equities / assets in general with those borrowed Japanese yen. Or if you see the market then switching over to risk off mode, you see an unwind of this carry trade, meaning that market participants are then aggressively buying back Japanese yen. And usually market participants refer to this as a safe haven currency, Japanese yen. In fact, I think it's more an unwinding of the carry trade in general. What does this tell us, or what does this mean? Well, have a look at what happened yesterday. So it's quite obvious that the equity markets didn't like what they saw here around the Fed statement, the dampened economic outlook for the US economy, and the fears around the stagflation, which started to build yesterday, pushed us aggressively lower. Same is true if you're looking at the Dow Jones, for example. Look at this. So this will be a very interesting day today because we are currently attacking the simple moving average 200. This happened several times in the past and we were capable of finding support in this region several times. But, and this is the thing, if we break below this level, there is minimum potential for the lows here from February, respectively here from April. So which can be found around 23,200 points. If we're looking at the current reading, this means that we have potential on the downside for 600 points potentially. So if this fear starts to build and we are about to see significant risk of coming into the market right now, based on those fears around the stagflation, and if this does not happen today, then potentially it will happen tomorrow if the non-farm payrolls disappoint. This is a very good starting point to potentially see equities then being sold off sharply. And not only that, but this could also mean some serious pressure which is then weighing heavily on dollar Japanese yen, pushing us again below 109, and probably very aggressively and dynamically pushing us as low as 107.50 to 108 on the downside. So it's not only that dollar Japanese yen is yield correlated here, but it's also risk on, risk off correlated. And if this risk off move or mode hits the market, not necessarily today, probably tomorrow, probably we anticipate it already today. Let's see. I mean, that's very difficult to say how the future will look like here. But the thing is that dollar Japanese yen has some serious corrective potential on the downside, and we could see a move which is probably pushing us 150 to 200 pips lower into the weekly close if risk off hits the market, probably coming from the Dow Jones breaking its 200 simple moving average. Plus, on top of that, data around the NFPs disappointing. This could both mean some higher volatility into the weekly close here, and something definitely worth watching. Then there's also, it's worth to have a look at gold. So in the morning meeting today, I emphasized again, I'm midterm bullish on gold. I definitely expect, or I see chances to be given quite high, that there will be an attack at 360, 365 on the upside. It's definitely something we should expect. Now, nevertheless, the question is, after the market fell here, I was all the time very positive. And what I told the audiences during my webinars was usually, I said, well, even if we're seeing some pressure here, which formed, by the way, for the last 2 and 3 weeks, the thing is that I consider chances to be quite high that nevertheless, or no, the chances to be high, but this is strength. Somehow I spotted strength in gold. Even though gold was selling off, it did not sell off as sharply as you usually expect gold to sell off once yields in US Treasuries hit 3% and probably even push above that level. And so today, now the thing is, not just today, but also yesterday, similar picture as in the euro. The interesting thing was that I said, well, it was very interesting to see that gold lost most of its gains here from the Fed statement, where you can see the market initially interpreted the statement of the Fed as you would expect it to be interpreted here. Then it sold off those gains again, nevertheless started to drift higher. And I said in the morning meeting, I said, well, if you make it above these highs, that's a clear bullish sign. And now with this retest, by the way, of this region here, probably you position yourself a little or an order a little lower than that, around 313 probably. I consider this to be a potential long trigger, let's say for the first half of a trade, from which I try to anticipate a midterm break above 360, 365. So let's say usually you plan to trade 4 contracts. If I was in your position, then I'd say, well, usually I consider a break above 360, 365 to be bullish, and I'd go on. I trade 4 contracts long from here, but probably it makes sense to split this order into 2-2, which means I'm buying the first 2 contracts in the current region, while I'm then buying the direct break on the upside for another 2 contracts, which is then nevertheless giving me a very attractive price, significantly below the breakout level here. That's the outlook for gold here. And by the way, I think we can also in gold expect some serious bullish action to happen if the data tomorrow, the non-farm payrolls, disappoint. So now what we want to do is let's have a look at the here at the, where do we have it? At the consensus range. So that's very interesting because the question many people might have is sometimes, or no, they look at the chart and they think, well, the reaction doesn't make sense. Market is going up when it's supposed to go down and the other way around. And sometimes people just do not understand why this is. And this has to do with something which is called expectation. And now the question is, where can we see the expectation of the market? And therefore, I want to snapshot this here. And what we can see is that obviously this is the non-farm payrolls, the number around the employment situation, which is currently expected at this level here, 109,000. Okay. But nevertheless, the interesting thing is, in fact, the consensus range, which is, in fact, quite bright, bright, not wide. It's a quite wide open consensus range here. It's 110,000. There's a difference. Same is true for the average hourly earnings. It's here. Probably even more interesting, based on the thing that we have this, let's call it stagflationary tendency, which was mentioned in the Fed statement. And now let me give you an idea of what I'm looking at here. So let's use Paint here. And now I want to do the following. So this is our this is a problem now. I can't copy it, but let me just try it that way here. So it will look like something like that. If you sum up all those analysts which are asked here what they expect, you will get something like this. So if you sum all these analysts up, and we are starting, let's probably put something here too. So we are starting somewhere here, and then we can say this is 155,000, while on the other hand, no, 45, right? One sec. 45, yes. And then we have another extreme, very positive one, 255,000. So other thing is the following. If the data comes in within this range, the market is obviously not really surprised. Obviously, because the market is expecting it. Well, it's expecting an outcome between 145 to 255,000. On the downside, a little less. On the upside, also a little less. Here within the middle, that this is like the consensus. The consensus is in fact the middle of it, which is then, if you, it's very simple in fact how to calculate this. So it usually looks a little difficult to say how can it be that the consensus range is that the consensus is 195,000. It's very simple. You just add up 255 and 145, and then you divide it by 2. Then looking at probably where is a little overweight. Yes, we call it overweight. Why not? So meaning if you have slightly higher amount of people seeing the data coming in around 145,000 and 200,000, then you have between 200,000 and 255,000. Well, then you probably reduce this number by something like 5 to 10,000, and then you're coming out at 190,000. So in fact, this is no rocket science how to get to these numbers. But now the thing is, and this is even more interesting for us, the question is, okay, what does this mean for our trading? Well, it means nothing more than everything which comes in between 145 and 195,000 or 190,000, every data set which comes in within this is not a big surprise. It potentially will result in the US dollar seeing some bearish move, but not necessarily a move which is against the euro, or especially against pound sterling or against the dollar Japanese yen, which will then result in a sharp decline of the US dollar. By the way, the same is true for the bullish outlook, probably even more than that, based on the run of the last weeks and days here in the US dollar index future. If data comes in between 190,000 to 255,000 in this part of this chart or graphic? Well, the thing is that we are here in this case. First of all, we are not really surprised to see such a number because market is already expecting it. Probably we'll see some kind of bullish push in the US dollar, but all in all, it's not that the US dollar should be expected to really take off from here if the numbers come in above 200,000 tomorrow, for example. So what you probably see is a last and sharper push higher in the US dollar, meaning Euro USD probably testing the lows from yesterday again around 1950. Probably the same is true for pound sterling. Probably dollar Japanese yen will rise again to somewhere in the region around 110. Nevertheless, a significant breakout on the upside with some bullish momentum then, which will result in a very, very deep green weekly close in the US dollar is, in my opinion, unlikely. It's not that it's not possible, but it's nevertheless unlikely. So based on that, we can clearly say, okay, well, when do we should expect real, especially in our case then, because the US dollar has already seen some significant momentum on the upside. When should we expect the US dollar really to potentially sell off sharply? And this is in fact the case when we come out here. Everything below 145,000, 150,000, probably can slightly push this higher to 160,000, but everything below that is definitely bearish for the markets, should be expected, especially for the US dollar. No, not the markets. Let's focus on US dollar. So that's what I expect. So if the numbers come in below 160,000, this is definitely a sign which could trigger another risk-averse move in the markets and bring not only equities under pressure, but also result in the US dollar to significantly weaken here. Even though we have to say, and that's also true, even though we have to say this move here in the US dollar is potentially also one reason why the US dollar has seen some significant trouble and problems. Probably if the US dollar sells off sharply, well, at least if it comes under pressure, gives back some of the gains. It's probably a better way to put it. If this really happens, well, then this could stabilize the Dow Jones. Nevertheless, could be somehow one good reason to expect the DAX then to drop sharply, because the DAX profited enormously from the weak euro, as seen yesterday. And if the euro can naturally gain against the US dollar, then even though it's not necessarily said that the euro will be the strongest counterpart to the US dollar again. So I think it's a better choice then to have pound sterling or the Japanese yen. Well, then I think the DAX definitely has some bearish outperformance potential. That's one good reason then tomorrow, for example, in the afternoon, to not only focus on US equities here, but probably also have a look over to European equities, and in this case to the DAX then, which could see some serious pressure. Nevertheless, if we combine US dollar weakness here with equity weakness and potentially markets being scared of stagflation hitting, well, then I think dollar Japanese yen is potentially our place to be. I think dollar Japanese yen has then some serious outperformance potential, which could mean that, well, again, that we're not just only pushing for 109, but significantly below that level, and potentially also gaining momentum, which can drive us as low as 107.50 to 108 probably. Yeah, another number to look at, sure, definitely, is the average hourly earnings. Even though somehow I'm a little skeptical right now, it's the same interpretation as here, as this data set. Even though probably the thing is that data didn't surprise in the last or around the last readings around the employment situation. So it's not that we should expect a big surprise here. Nevertheless, if the consensus is 0.2, if we come in at 0.1 plus the employment situation disappointing, this could be another and even more aggressive driver for US dollar weakness then. And fears, or pushing fears higher around the potential stagflation. because average hourly earnings usually, and in a very rough way said, can be considered at the amount of money people potentially have in their pocket. And if it's less than what is expected on average, well, you shouldn't expect, in this case, consumption to be quite high, which is a bearish sign for the overall economy. Can be interpreted that way. It's a very rough way to interpret it. Nevertheless, something worth remembering when looking at the employment situation. Let's assume numbers around non-farm payrolls happened in the past, by the way, several times, come in better than expected. And let's assume they're coming in at 200,000, probably slightly higher than that. Nevertheless, US dollar can't really gain momentum. That can have two reasons, or it's probably a combination of both. First of all, the dollar has already seen some strength. So many of a good employment situation report is potentially priced in. Plus, on top of that, it's also true that average hourly earnings are probably an even better indicator of how the economy is doing, respectively, is expected to do in the future. And this could mean that even if the employment situation looks quite bright, average hourly earnings indicate that people are not having enough money in their pockets to consume and to keep this overall positive outlook and growth in the US economy alive, let's say. And once again, it's very, very rough set, but nevertheless, it gives an idea of what drives markets during those times. So 1 second, please. I have to look up something here. So, okay, perfect. So then let's come to the question here from Nakul. Am I right? Is this right? I just hope so. His question is around crude oil. So there's something I have to add here, because he's asking for how to trade crude oil. So what I can tell you, based on my personal experience, is the following. I've traded crude oil quite actively and also professionally in the past. And nevertheless, my experiences, especially in the shorter term time frames, let's put it that way, is not really positive. Yes, not really positive means that the overall results were okay. Nevertheless, what I really had trouble with was getting good execution. So I'm not referring to I'm not referring to CFDs. I'm sorry, that was the word I was missing. But I'm referring to crude oil futures. So we traded crude oil futures directly at the NYMEX back then. And so the problem is that especially, not especially, but it's difficult sometimes to get a good price. So because it's a very, very slippery environment, let's call it. So slippage is always a topic, and it was really difficult to trade crude oil profitably based on our sometimes horrible execution. So now you might say, well, look for a great broker. Hey, you looked for a great broker and found one in JFD Brokers. Well, this is the thing. I mean, this is not necessarily sad, because usually you're rather sooner or later you run in troubles, get enough, let's call it material, to buy, respectively to sell. And sometimes, especially when trading lower time frames, that was one of the reasons why we ran in some issues here. And based on these experiences, I skipped, or it's not that I completely ignore commodities in my trading, but my main traded asset, for example, is the DAX, respectively some currency pairs like Euro USD. Currently, it's mainly Euro Japanese yen, for example, but it's not WTI. So if I'm trading current markets, commodities like WTI in this case, or crude oil, then I'm usually looking for trading approaches which are known as so-called pair trading approaches. So I don't want to dig into details here, but it's usually the case that if you have so-called fungible assets. I'm not even sure if this word exists. 1 second, please. I just have to see. So in German, it's fungible. So that's just why I use this word. But let me just see. Fungible. Yeah, okay, it's perfect. So it's a fungible. And then what you could look for is differences between crude oil and Brent, for example, occurring, and then you have a certain threshold, and you expect this difference between those two prices rather sooner or later to narrow against. So there will be a commodity which is overvalued, and there will be one which is undervalued. And rather sooner than later, there will be they will converge again. After diverging, they will converge again. So you're buying the undervalued and you're selling the overvalued, and that way trying to profit from convergence happening here. So when looking at those markets or when trading them, these are usually the approaches I'm trading, even though currently it's not an active thing. That's main reason is, by the way, that it's not automated yet in my trading, but could be a topic rather sooner than later. So in fact, I'm currently working on several projects here to even increase the overall portfolio of traded strategy in the managed account I'm offering. So, but now let's have a look back at that crude oil here in this case. So what we want to do here is in fact something. Let's focus here on the overall analytical side, respectively on the research side, and potentially trying to identify an advantage, but not necessarily say how to trade WTI. So the thing is that currently we can clearly spot an uptrend channel here, an uptrend. It's an uptrend. It's not necessarily a channel. Higher highs, higher lows. So the advantage overall should be seen on the long side in crude oil. So now it's not only that we are seeing the advantage on the long side, but probably we are also trading in a region where we could consider long engagements to be attractive. One reason is that we just broke out 2 new highs here above 66.50. Yeah, 66.50 to 67. And now we're retesting this former resistance here, and potentially can consider long engagements against these regions, because as long as we're trading above these highs here, actually, I'm sorry, lows from April around 62, well, the overall advantage based on market structure should be seen on the long side. So now there's just a problem, because yes, we can clearly and classically, let's say, trade crude oil long against this region here, also based on the overall positive outlook, based on this uptrend and clear advantage which can be found on the long side. And this is the next thing. If you zoom out of the chart, well, you can see that there is probably potential up to over 90 USD per barrel here. So it's not sad that we're yet done with this trend which is formed here, but potentially there's further room on the upside, which could bring us here towards the region of these lows from 2014. Is it 14? No, it's, yeah, the lows came later, but it's the lows here from 2013 minimum. So now the problem is, and this is something where the fundamental perspective comes into play. So let's come back first of all to this little anecdote which I presented at the beginning here when we looked at crude oil. Well, the thing is that when trading WTI from a position trading perspective, I only consider longer term engagements here. And now the thing is that the longer the time frame, the more information you need to have to build a position. In this case, also bringing up fundamental outlook. And here we can close a cycle with what happened with the Fed yesterday. So the thing is that we already know that there is a potential recession forming on the horizon here. This is mainly due to the fact that the spread between 2 and 10-year yields is probably collapsing is the wrong word, but it's nevertheless, it's below 50 basis points. And this is a level which hasn't been seen since 2007. You know what shortly afterwards happened here. So usually when seeing the spread between short to long-term yields narrow that aggressively as we currently see in the US yield markets, that's a first indication of potential recession. Recession is something which is definitely not positive from a fundamental perspective for crude oil, which means that even if you, from a technical perspective, can formulate a very, very bullish scenario for crude oil, from a fundamental perspective, you should be really, really careful, because with a recession forming, it's more likely that crude oil will at least see some difficulties, or seeing some headwinds here on the upside, respectively, probably seeing some pressure from the upside forming, and not pushing significantly higher from here, but that's potentially the positive outlook then. See some choppy price action occurring, similar to the one which we've seen here over quite a period from 2016, mid-2016 till, yeah, in fact, till the breakout happened. That was in November 2017. So it could be that there is some on the intraday perspective, short-term timeframes, that there will be some trading opportunities, but from a longer-term perspective, probably the outlook for crude oil is not that positive, especially not after the Fed statement from yesterday. So I'm a little skeptical here for WTI. Yeah, thanks a lot to Karim. Is this right? Karim or Kareem? So sometimes it's really it's difficult to know how names are spelled. So again, the question: tell me the best time frame for trend line. Well, this is something which is really difficult to say. Well, it's especially for me really difficult to say, because I'm not a big friend of. It's very difficult for me because I'm not a big friend of trend lines. But what I appreciate, or what I like to do, is to look at the market from a market structure and then work with different time frames and let them play with each other, let's say. Yes, this is the same is true for intraday trading. So let me just see how I can present this. 1 second, please. I just try to save some time, nevertheless, have the best possible chart to illustrate my thoughts here on this. So you can see a trend line here. So some of you might now wondering what I'm talking about, since I've drawn a trend line here into the chart, well, which is completely right. Yes, nevertheless, it's only for illustrating purposes for some other traders which are listening to me in my morning meetings, German or also the English version. And since I know that some market participants, traders, are looking at trend lines, but the thing is that I'm not one of these traders. And now let me just see. That's really cool. Yes. So first of all, let's have a look at this. It's probably very interesting. So as you can see here, if you're trading, let's say, a 1 minute time frame, then I'm not only looking at my dominator, but I'm also looking at the dominator of my dominator. So this means you all the time, depending on which time frame you're trading, should have a look at the time frame which is directly dominating you, which means nothing more than these are, where this is the next market participants who has potentially deeper pockets than you have, because the time frame he's trading here means that when let's say risking 1%, no, not 1% of your equity, but looking at an absolute distance when setting your stop, for example, and defining your risk, that here in this case, someone who's trading a higher time frame will naturally, based on the higher volatility in this higher time frame, will have to have an overall wider stop level, which means that if he wants to trade, or if you both decide to trade the same position size is wrong. No, it's if you want to trade the same contract size, contract size, is that right? So if you want to trade the same amount of contracts, obviously the one who dominates you has to have deeper pockets because his stop is wider. If you both trade 10 contracts, let's say, that means nothing more than this account, or his account has to be bigger than yours. So what you usually try to achieve is to sail here in the shadow of your dominator if you want. So if he's about to buy, you probably should avoid to sell, and vice versa. And this is also true. This is some kind of, I think in poker, this is something people refer to as a meta game. So it's the same is true here for the next time frame. So the same is true for the dominator of your dominator. If you see that your dominator is about to potentially buy, and there is the dominator of the dominator which is willing to buy too, well, you have two potential drivers in direction of the trend, which you usually should use for long engagements yourself. So now you might wonder, okay, and how do I find out whether someone wants to buy or not? Therefore, you have to look at the overall market structure. Therefore, I have something here. Does this work? Hello. One sec. No, this is not working. Let me just do it that way then. So therefore, you have to understand market structure in general. So trend structures in this case, higher highs and higher lows probably. That's the most easiest way to understand this. So what you can see is building a position when the market makes new highs into the distribution area is not optimal. Okay, this is something which is a little advanced, let's say. But let's have a look here at the distribution area and accumulation area. So what will market participants usually do, especially professional traders? Well, they will definitely avoid to build a position here since the risk reward is not attractive enough. Plus, there are several reasons to be skeptical whether there's enough material available here within this region. Remember what I just said around crude oil, for example, and when trading crude oil in lower time frames. And so the thing is, from a risk reward perspective, entering a position here is not optimal. And so what they usually try to achieve is they are buying into a retracement. And thanks to buying into retracement, what you'll naturally get is a more attractive risk reward in this case. So let's have a look at this chart, therefore. So what you can see is that if you're buying here, obviously the risk when you're building a position is this whole green box. And then we assume that the market will move that way in your direction. Okay, that's great because now you have a positive risk reward ratio, which is higher one. Nevertheless, if you are buying here lower than that and into the so-called accumulation area, well, what you usually see is that your risk decreases while your potential chance increases. And this is usually what you're looking for. So try to get an even more attractive risk reward ratio. And now your question is, okay, how do I trade this? And therefore, I'd like to show you something else. So there you can see, once again, please remember when, where is this? Here, please remember when looking at this chart now. Please remember that when looking at a 4-hour chart, I'm sorry, a 50-minute chart here, your direct dominator is the 4-hour chart. Okay, so 5-minute hourly, 50-minute 4-hour, or 5-minute 4-hour. I mean, FX traders would potentially look at the 4-hour chart. The thing is, you have to remember this. If you have this table here, you know that your direct dominator will be, when you trade the 50-minute chart, you will have potentially direct dominator 4-hour chart then. So when taking out this and now looking at the following, you will understand what I'm talking about. Have a look at this. So you know that the overall structure on a 4-hour chart is higher highs and higher lows, so it's an uptrend. The market sees a corrective move, which we'll naturally see on a 50-minute time frame here as a sequence of falling highs and falling lows. That's usually what will happen. So now the thing is that the market will see such a first small attempt to stabilize, let's say. And now the thing is, what we know is that if the market makes it back here, in this case of R1, this is the last relative high. The last relative high we get to see here holds this sequence of falling highs and falling lows in play. Meaning, if we make it above R1, then the structure of falling highs and falling lows is broken. So there's no downtrend anymore. So this trend here, if you look at it at a lower time frame, is broken during this time, or in this moment. So now the market starts to see a sequence of higher highs and higher lows from here. And what we then do is we try to trade a break, no, not a break, but a pullback towards the former high here, in this case, from a long side. And the great thing about this is we position ourselves here on a 50-minute time frame in the so-called accumulation area. And this is also true when we're looking at the 4-hour chart, because here, the 4-hour chart, the dominator, our dominator, is buying into a potential strength here too, respectively, in the so-called accumulation area himself. So our dominator is willing to buy here. We are willing to buy here. And well, again, when we're willing to buy, that's nice. Nevertheless, we have to see what our direct dominator does. If our direct dominator is buying too, well, then we definitely want to buy here. And this is becoming even more true once the dominator of a dominator, the daily chart here, we don't overcomplicate things now here, but also wants to buy. And yeah, this is usually a way how you could trade different time frames and not necessarily trend lines. So this is the thing. This is a very detailed answer to a question. In fact, this is one reason, or this is how I look at the markets and how to position myself based on trends. I don't do this based on trend lines. I don't really like this. The question here from Mega Montana is, will this be released on later? Do you mean if the recording will be published? Yes, I think so. Yeah, here on FX Street, definitely. I think they publish all recordings of the webinars, and so this will definitely be available here. And what's your maximum risk on oil? I think this depends highly on my overall trading approach. What I can definitely say is that based on the fact that this is not my main traded asset, the risk will naturally be less than 50% of my usually taken risk and positions. So let's assume that I'm trading a system or trading systems. Well, I risk all in all 1%. If I had to add a WTI position, I'm not necessarily on a trading system, but based on a discretionary trading approach, I potentially risk 0.1 to 0.2% then of the overall portfolio I'm trading. Okay, so now I've seen that's already 4 minutes. 4 minutes. I'm overdue in this case. Thanks for your time. I much appreciated all your questions. I hope that you enjoyed what I had to present here, and I wish you all the best. Happy trading. Watch your stops. Take care. If you have any questions, by the way, just shoot me an email. I'd really appreciate it. And yeah, that's it from my end. So all the best. Take care. Talk to you later. See you. And